Great. Well, thank you so much all for joining. This is the introduction to the early stage investing series that we are launching at She's Independent. It's great to have you. I did mention this, but we will be recording this session. If you can't join the series live, it will be circulated after the fact. So we hope that you learned something today and join us for the bigger series. So welcome. A lot of you, ahead of today had reached out saying, well, I'm interested, but I'm not sure that I'm ready to dive in and invest tomorrow. And that is absolutely fine. I'm going to share a little bit about, what we're going to cover today and the purpose of today, but it's great that you're here. I promise that you're going to learn something. You may learn that you don't want to invest, and that's okay. But you may also learn and gain some more confidence around how you're navigating an equity compensation negotiation. You may just think about how you want to navigate your career and maybe start investing in, early stage businesses. But really the intention today is really just to plant some seeds, which is what you're seeing up on the screen. By starting the conversation, by starting to learn some of these concepts, it means that you can dig in deeper. It means that, these concepts, which again, may be very foreign to you, maybe you don't have a finance background like me, that's okay. In this investment series, out of today, we are going to dive in and go into more detail, give you some homework assignments. But just getting the dialogue going, it's going to allow you to more confidently navigate and also ask the questions to figure out what is the right journey for you. So we're going to spend some time talking about, what we're going to cover in this series. But we're also going to talk about equity compensation because I know it's something that impacts so many of us. And it's also something that I think is a pretty opaque area where there's not much information that you can Google. So I know it's something that friends always really enjoy hearing about, and I'm excited to share some learnings with you today. So a little bit about me, since I will be the course creator and somebody that will, kind of share the most throughout the series. I'm Natalie Levy. I'm the founder of She's Independent. I'm an engineer and mathematician who used to trade Wall Street derivatives. I also ran private equity deal sourcing in San Francisco at a fund, and I'm an enterprise technology sales leader as well. I've held numerous operational and leadership roles in various technology businesses, and these span from bootstrapped and seed funding, so either no funding or a very little bit of funding, through to Series A, Series B, Series C, bigger funding rounds and checks, and even more mature businesses. My background operationally and on the investment side has mainly been B2B or business to business, where one business is selling into another business, and enterprise technology, so kind of deeper data and technology products. But I do have experience beyond these sectors. In terms of my investment credentials, I'm really thrilled to share that I've had 3 successful exits out of 15 investments. I also have seen returns across my entire tech portfolio prior to all of my investments before 2018 of between 5 and 70 times. So that means you put in 10,000, that's the 700,000 that I quoted in an email that I know got some people to sign up, which was really exciting. I'm a huge fan of mindset work, mental health awareness, and also gender equity. And through my She's Independent business, which is, of course, the business that's running and launching this series, I'm excited about sharing, and inspiring and offering low-cost ways for women identifying and diverse individuals to identify or really capture what is their voice, what is their professional path, how do you start speaking up in the office, and how do you get on the cap table, or how do you become an investor? So if you enjoy this introductory session today, I do hope you'll sign up for the series. It would be great to have you. I'll share a little bit more info later on. But now for a quick PSA, public service announcement, excuse me. You absolutely belong in this conversation. I have a, I guess, interesting picture up here. It's me in some short shorts holding some cash money bills. But the idea is you don't need to look like anyone. You don't need to be anyone to be an investor. This is a fun, image grab from our Instagram, but just a reminder, anybody can be a deal maker. Anybody can be on a cap table. So for me, early stage investing has been a really fun and rewarding journey for a number of reasons. I've met some great people. I've found some new roles. I even, happen to make some ridiculous money in the process, but it's not just about the money, right? And I think that that's an important piece. Also, if we're talking about gender equity, so often, it's just men in the room. It's just white men in the room a lot of times, when we're talking about investors. And so it's really great to say, how do we show up? Because a lot happens in the boardrooms, on the cap tables, a lot happens in the investor rooms that is not reaching the employees. So I'm thrilled to, have a lot of you here today and to just get the conversation started. The other thing, to talk about is, even if you don't want to start writing checks tomorrow, that's okay. Let's say you don't have enough money in your bank account, or you're figuring out the concepts. That is absolutely fine. You can still be an investor and you can still have exposure to equity through compensation packages with your tech employers, or really private company employers that are open to giving you equity. We'll talk about that. But a huge part of it is not just getting shares, but it's understanding what's the value of the shares that they're giving you. Shares don't mean anything. What's the percentage? And we'll talk about that. But getting you more confident, understanding a little bit about valuations, questions to ask, what you can expect or ask for. So really great concepts. So a quick overview as to what the investment series itself will cover. Today, it's more of an introduction. We will, go into some more immersive 3 single kind of hour workshops. You'll get some accompanying exercises, kind of take home homework to get you really learning these things and feeling more confident in terms of how you communicate, how you're digging into the concepts, but really just getting you more confident in having the conversation and learning. So this is a quick breakdown of kind of what we'll cover in the sessions over the coming weeks, I should say months, because the sessions will meet bi-weekly. But if you're eager to get started sooner, or if you want another freebie, we do have on our website a recording from a panel discussion with a handful of tech investors in Colorado, where we talk about ways to get involved, ways to, maybe sign up for newsletters, what you can read. So that's another great informational session if you want to learn more. Okay, so let's dig into something that I know many of you today are eager to learn about, which is, how should we think about equity ownership? How do we start, more intelligently navigating this conversation? What can we be asking for? What should we be asking for? So let's just pretend that you don't want to write a check today, which is absolutely fine. What is equity ownership? What is equity? And by the way, you're welcome to participate in the chat. You're also welcome to, if there's space for it, you can come off of mute and you can ask questions live. But I will kind of go in and start answering things, but you're welcome to participate. But with equity ownership, what I'm talking about is exposure, or the ability to participate in upside or growth of that company. So if we are talking about, let's say, a public company, you can buy shares, right, on, let's say, the exchange if it's publicly traded. But if we're talking about a private company, so let's just pretend that the company you work for is a tech business and maybe you have some investors. There's the concept of the cap table or ownership structure, where you can't go out and buy shares, in the open market, but you have the ability a lot of times, being an employee at a private company, of getting some share exposure or equity exposure. How do you get that exposure? You have to work at an employer who's open to giving you the ability for equity ownership. And I will tell you that oftentimes, private companies are open to it, but sometimes you have to negotiate a little bit. If the private company has already raised, hundreds of millions of dollars, it's going to be harder to get, substantial equity. But a lot of us, are working at companies where maybe it's like a few $1 million raised, maybe 20 million or 50 million raised. And you absolutely should be getting some equity exposure. So what are shares worth? This is something where it's really opaque. It's a gray area. There's so many things we could talk about. But I have up an image. I took a screenshot from a company website called Crunchbase. Whenever I'm thinking about who is this company, right? What's going on with the company? If I'm interviewing, if I'm looking at a role, if I'm thinking about, evaluations, there's a few things I'll do. But Crunchbase, is a great place to start. Because what can I quickly see? I can quickly see how much have they raised, right? I can see when were they founded. I can go on places like LinkedIn to see, how big is the team. But the point is, Crunchbase is giving me a really quick, concise profile of a lot of these private companies. They have pretty good coverage. It's not 100% accurate, but it gives me a really good, quick glimpse or snapshot of what's going on at the company. You, of course, can run, Google searches. Sometimes you can get more, up-to-date information by saying, looking at funding, or even on the company's website, they might even talk about funding. But Crunchbase, for me, it's a great place to start. So how should we think about valuation? Okay, so there's a lot of things we can talk about here. Private companies are not going to be reporting what they are doing publicly. So you can't go on the website and look at the investor relation part of the website and see what did they say on their annual report or their quarterly. That doesn't happen. But you can start to get a proxy or start to think about where might the revenues be? Where might they be in their stage of business by looking at things like how long have they been around? How much have they funded? How much fundraising have they raised? How many employees do they have? You can also look at, as a proxy for value, what was the latest valuation, which may or may not be something that you can actually find by looking on Google or looking on Crunchbase, or by just talking to the employees, or I should say even the hiring manager, your manager. So for example, when I'll go through a few examples of this, but when I was joining, a Series A backed company, I knew where the Series A valuation was. So I was able to back into what ownership were they offering me in terms of, how many shares or what percentage of ownership were they offering. So you never want to think about shares. Never, ever, ever think about shares. I'm not going to go into this one in a lot of detail today, but it's really to introduce the concepts. And I would give some homework and assignments kind of around the series, but the concepts of what is the percentage, right? There's 100% ownership. Where does it go? Who's on the cap table? What is the percentage they're offering you? I don't care if they're going to say, hey, Jen, here's 20,000 shares. Because what if they have 2 billion shares? I'm making that up. It's a high number, but what is the percentage? Because if I don't know the percentage, if I don't know how many shares as a percentage I have of the business, I'm not going to be able to kind of back into that valuation. So if I negotiate as a senior salesperson early on in the business, 1%, and the last valuation was $20 million, wow. What's 1% of 20 million? Right? So you can dig into, right, what is the percentage, but shares alone mean nothing. And it breaks my heart, honestly. So many people, the sweat equity, and they're working so hard and they're like, oh my God, but I have these 15,000 shares. Doesn't mean anything. I mean, it's something, but you don't know the value, right? And by the way, valuation rounds and raises, and somebody raising at a 20 million pre or post. And what am I saying? I'll describe more of that later on. It doesn't mean anything really. Founders, it's about a story, especially early stage, right? A lot of Series A, a lot of angel rounds, it's the story. They haven't really executed that much. Series B, Series C, they're starting to de-risk, the numbers are playing out, but a lot of these early stage companies, it's a story. And by the way, I guess I'll date us today because people may listen to the recording. November 2021, we are in some type of bubble for private valuations. They're insane. I read something recently that unicorns or billion-dollar valuations, the average top line revenue is only about $25 million. The multiple expansion, the amount of liquidity, coming into our market, it's insane. And at some point there'll be a correction. But the point is, valuations really depend on what are people willing to pay? What are the investors putting in? Where's the exit of the business? So valuations, right? It's really this concept that you should understand, but also know just because they raised, it doesn't mean is it really worth that? It's probably a bit of the story. A lot of it's the story. Vesting, right? Understanding, say you're going to join that startup and you're so excited and eager, but you know that you're going to put in so much work and you know that after a year, you actually have another plan to do something else. A typical vesting schedule, when you join as an employee, it's going to be a 1-year cliff. You're going to get no vesting, meaning you get no actual ownership for the first year. And it's usually 4-year vesting schedule, meaning after the 1-year cliff, then it vests over the next 3 years. It's okay if that has to sink in. The point is, right, if you only plan to work at that business for 18 months or 24 months, you're not even going to get, the 4 years of vesting. So if you negotiate that 0.5% or 20 basis points, by the way, means 0.2%. You're only going to get, if you stay for the 2 years, 10 basis points. And you're probably going to be getting options, because that's what most companies do for employees. You're going to have to pay something to exercise the options. Again, a lot of concepts here, just letting a little bit of it sink in. We're going to go into this in more detail, in the series, but this idea of, right, what is the ownership structure? You have to, ultimately exercise your options if you want the share exposure, but how to think about this and how to intelligently kind of ask the questions. So I'm actually going to give you a few real examples, which I hope will be good learning experiences. And I am telling you, I took these screenshots from Crunchbase actually yesterday. So publicly available information. But I'll share with you a little bit of kind of how I worked through, some negotiations and asks. So, what ownership percentage can you expect? Notice I'm not saying share count. What ownership percentage? Because that's how you should think. How big is the company, right? Again, are they earlier in their journey? Have they already raised a bunch? What's your role? Are you coming in as a senior leader? Are you C-level, C-suite? Are you a VP? Are you building a team? Are you coming in just as an individual contributor? All these things are fine, but it's going to ultimately feed into that story of what should you get, right? What are you going to be worth there? What can you ask for? So in this case, I'm giving you an example of a company that actually just got acquired in the last week, which is exciting. And when I joined them, it was 2014. I joined them in 2014. They were Series A backed. They just closed their Series A round. And I was joining them as a sales leader. Not the VP of sales, the director of sales. So senior, but not running a division. The first client-facing hire. And I was crushing it and a big producer in my prior sales role. So I worked like hell, excuse my language, to get 1%. And they said, wow, really? I can't believe you negotiated that, but I got the 1%. I didn't stay for the 4 years, but I stayed for about 2. We also went through various funding rounds. And the reason I'm saying these things is that basically means your equity piece or your percentage can be worth less. However, the valuations are getting bigger. So ultimately, you do end up making more, even though you're getting kind of pared down as more valuations happen, assuming valuations happen at higher amounts, which typically they do. So in this case, right, I negotiated really hard. I ended up not having near 1%, but still a really good stake in the business, even though they went through multiple raises before that acquisition, and I was only there for the 2 years of vesting. But you want to know what else I had to do when I left that business? I had to actually exercise my options. So I actually had to pay something sizable to have the privilege to be able to ultimately own the stock that the options gave me an opportunity to buy. And I had a taxable event. I know other people at that business, they didn't exercise, they get no participation on the acquisition. And that's okay. And by the way, I partially exercised them because I put in so much damn work. I wanted to make sure that I wasn't kicking myself if anything happened with the business. Okay, I love this. So we have a question in the chat. Do you have experience negotiating for more ownership after adding value to the organization for over 1 year? Love that. There are absolutely there's always the ability to negotiate on your comp package, which includes equity. However, the further the company is along in terms of revenues and traction, funding, it's just that much harder to get, let's say, increasing exposure. The way companies typically do this is they carve out, an employee option pool. And when you start, getting further and further into the investing and fundraisers, you almost come up with more of a board approved for this role. This is the equity we give. But let's just say you get a promotion and now you're not just the director, you're now the VP or you're now C-suite. Absolutely, you should expect and you should negotiate, a bigger chunk of equity on the back of that. And even for really great participation or really great work at the business, you should see about, could you get some more equity in the business? I do want to pause for a second. Equity is great, but cash is king. If you're from finance, you've heard that cash is king, right? Cash is green. You can spend it. You have it today. I am not a fan of just working for equity unless, and we'll get to that later, maybe an advisory role. But the point is, you really want to be compensated and you really don't want to just be thinking about how might I get paid out in 4 to 10 years, right? Because that's not how most of us live. I'm doing a little bit of that now for fun because I can, but the point is, you also want cash. You also want bonuses, right? But the equity piece is great, but don't bank on it. Don't bank on or spend, like it's money in your pocket. And by the way, I think another thing I like to say is, and we talk about this in the panel discussion, which is a recording you can listen to, I like to think about angel investing as kind of horse betting, horse racing. You can actually have an edge if you do the research. And by the way, I'm not great at horse betting, but the point is you're not always going to win. And so, the way to think about it, if you're building up an angel portfolio, is you want a bunch of investments and you really don't want to put more than 10% of your net worth into this type of asset class. And by the way, you really don't want to be investing in this asset class, meaning it's fine as an employee, but you don't want to be writing checks unless you have the assets and money to do it. I'm not going to get into that more in this discussion. We talk about it in the panel discussion, which is recorded. I will make that, by the way, the panel discussion. It's linked from the website, she'sindependent.com, the course homepage, so you can access it there. The other thing you can think about negotiating around is maybe there's some way to get anti-dilution or not to be diluted, not to lose ownership through future raises. That's something you can negotiate around or ask about. Okay, let's talk about another example. So another example is when you're asking for thinking about equity, right? Something I love to ask you or really to dive into, and we'll dive into this in the series, is what do you know well? What's exciting to you? Where do you see the prospects of the business? Where do you see it going? So one of the companies I started doing work for, I started looking at as an investor before I was up for joining them on the employment side. And they were so interesting, the story and the traction they already had. And they were in this place where they're closing big deals. And there's this, it's kind of unsexy what they do, but it's a huge market. It's a huge market opportunity. How much have they raised, right? How fast is it growing? And some of these questions are pretty opaque and pretty tough. You have to dive into them. Ask the questions. And we'll dive into these more in the series of like understanding valuations, but is it a 20% year-over-year growth, 50%, 100%? 100% year-over-year growth, that's really exciting. 50% can be exciting. Under 50%, if it's a small business, it's less exciting. Funding, we already talked about it, right? But if they've already raised a ton, it's going to be that much harder to get the exposure, and that's okay. So the company I have up here, Candu, which is this Israeli-based company that I'm working with, they'd already raised a little bit more than that prior company I worked with called Reonomy, right? These are real companies. So I knew I'm not going to get anything near the type of equity, let's say, that I got in my last role. But that doesn't mean it's less exciting. Because ultimately, right, what's the valuation going to be? What's their trajectory? That's what's exciting. The other thing to think about, vesting schedules. let's just say you're coming in as an interim executive or change management, you're coming in to do something really critical, but it's really a shorter term project. You can't do a 1-year cliff. So thinking about what you need and asking for it. All important things. Now, this is a really important slide I wanted to bring up. I just did a really, really great course all about, boardroom seats, advisory roles, and again, just getting creative. Vesting schedules. If you are an advisor for a business and you're adding value immediately, you either don't want a cliff at all, or you want a really short-term one, maybe 3 months. Maybe the vesting schedule vests in 6 months, right? I've negotiated this. Equity, what are we talking about? I've seen advisors get 10 basis points or 0.1%. I've seen them get 0.5%, 50 basis points. It's all over the map. Again, no one talks about this stuff unless you're having the conversations. But the point is, what can you ask for and what should you ask for? Think about the stage of business. Advisory, right? It's less execution. So maybe it's less time spent, but it's strategy and it's really high value work. And so even if you're putting in less hours, you might be able to get more equity, way more equity for the hours you put in just because of the nature of the role. A really exciting type of opportunity. So I sit on, 2 small private company boards. It's a way for me to get equity exposure. I may also write checks to get even more equity exposure if I really like what they're doing, but it's just a really great way for me to participate. And I could even get equity just by sitting on the board and not writing a check. So many different ways to think about this. I know we are right up to the time that I'd scheduled for today, and I want to make sure that we're also opening it up. If you had questions about the series, I brought up the link so that you can visit us and sign up for the deeper series if you're interested in that. But let me know, is this helpful? Do you have questions? I am hoping that you started to gain a little bit more confidence around what is an equity package? What can you ask for? Again, numbers are all over the place. But just by starting the conversation, by starting to dig into these concepts, hopefully in the coming years, you'll not only start vesting with equity, but I don't know, over the next decade, maybe you'll start getting some checks from those investments. Great. So that's what I had prepared. Thank you so much for joining. The hour-long sessions for the series, they're going to kick off November, let me think, 2 weeks from today, whatever date that is. We're having a bye week for the last week of December. So yeah, you'll get recordings even if you can't join live. Really looking forward to it. And then the other thing is we'll have a few other investors participate as well. Some really great investors who will weigh in and share some of their sourcing and how they find investments, how they really uncover what is their investing superpower. And I'll do some of that as well. So hoping to see you there, and let me know if you have any questions.
Thanks so much, Natalie.
Yes, absolutely. Thanks so much for joining. This was great. Anyone else have thoughts or questions before we hang up?
Awesome. Thank you.
Awesome.